Alrighty, Mega team, welcome back to the channel, guys. Thanks for tuning into today's video. We have an interesting video today. We're going to be talking about the implications of the FOMC interest rate hike on the broader cryptocurrency market as well as the financial markets as a whole. We're going to be discussing the strength of the dollar. We're going to be talking about the recent price crash on Bitcoin. We'll talk about where we think the price is going on the short term, if this has changed the macro environment, and if so, where we think the price is going on the macro scale. Let's go ahead and get into it. Before we get into it, guys, head down to the pinned comment below. Click the first link, join our Telegram channel, get access to all of our updates, analysis, and much more. We posted a lot of updates in regards to FOMC in there yesterday to keep everyone in the loop. So let's first and foremost talk about the interest rate. So obviously it came in at 0.75. And if you remember, 0.75 was the consensus. It was about 82% of people expected 0.75, whereas 18% of people expected 100 or 1.1%. So it did come in a consensus, and it poses the question, why did the market crash if we got the result we were expecting? And to answer that, we have to look at two things. And we've talked a lot about this on this channel already. We have systematic risk, and we have perceived systematic risk, and we have actual systematic risk. So you have systematic risk, which is essentially everything in a market that you cannot control. Interest rates, for example, inflation, monetary policies, tax policies, all those things that impact the actual return on the investment that you as an investor don't have direct control over. So the reason why the price has crashed is because although perceived systematic risk was perceived to be bullish, and I'm saying perceived because it was anticipated that 0.75 was in fact the consensus, with 82% of people expecting it. Therefore, it perceived to not have a bearish impact on the market upon that release, as people should have been prepared already for that news release, right? The problem is adding 0.75% interest rates actually brings up the total rate and therefore brings up the actual systematic risk in the market. So if we go back to this chart over here, we talked a little bit about the connection between interest rates and currency prices, asset prices, and we had another chart that I don't currently have at the moment. I accidentally deleted it, but I'll have to draw it up in another video. But it shows you how changing systematic risks actually changes the risk-return ratios on these investments. And as risk-return ratios get less favorable, people are less likely to invest and they're less likely to hold. So obviously you're thinking about taking a trade. If it's got a really, really poor risk-reward ratio, you're probably not going to be taking it. And the same thing goes to holding or long-term investing. It's got a poor risk return, you're probably not going to be holding, you're probably going to be looking to selling, or you're probably not going to be buying, and it kind of drives these asset prices down. And it's exacerbated by the fact that a lot of companies have acquired a lot of assets on debt. But let's talk about this real quickly, because inflation obviously came in a little bit lower. It came in a little bit lower at, I think it was 6.3, if I remember correctly. It was a few weeks ago now. And interest rates came in at 0.75. So 0.75 was the same it was last time. The last interest rate hike was 0.75. And we already know that 0.75 plus previous interest rates hikes equals a greater number compared to previous. So interest rates as a whole, the actual number, the actual systematic risk has increased, because remember, interest rates is what impacts everything else. If you look at this chart over here, and I'll show you on another chart in a second, but interest rates is what actually impacts everything else in this chart. So interest rates, as a matter of fact, is one of the most important factors when altering systematic risk in our current financial markets. When we alter interest rates, we're directly impacting systematic risk, which directly impacts this entire flow chart over here. So what we're seeing, interest on debt rises, sure. People who have companies, people who have acquired assets on debt, whether you've got a home loan, whether you've got short-term debt, long-term debt, you're paying more money back per repayment because your debt obligations increase. Obviously, if a company is holding these assets and they're decreasing in value, the risk return ratios now become less favorable and they're paying more money to these assets to hold them with less return. Their cash flows decrease, they have to load, they start selling off their balance sheets, which drops the asset prices. With household, obviously household available cash flow decreases when interest on debt rises, okay, and therefore they're less likely to acquire assets or more likely to sell assets to pay off their interest on their debt or to pay off their debt in a lump sum, or even just to have more available cash flow. So you got a little bit of a buffer. Very simple stuff, guys. That is essentially what's happened. The actual economy itself, the added 0.75% has put us in a greater situation of systematic risk. It's increased the risk in the market. It's made the market more bearish, even though it was anticipated, even though it was expected, even though it was priced in. It has made the economy worse, okay? Now we don't see the effects of that right away. Now this is where it gets a little interesting, because we've talked about, I'm gonna move up over here. We've talked about how financial markets work, and we've talked a lot about how financial markets move in relation to future potential changes or shifts in that risk return ratio. And when I say risk return ratio, we're talking more about the direct impact systematic risk has on the risk return. So we've talked a lot about that. I'll quickly go over it again. So if the general consensus is that, say next month, inflation is going to come to 5%, interest rates are going to come down to 0.5, what reaction do you think that's going to have on the market right now? Well, obviously the market will rally, okay? And it happens preemptively because financial markets front run a lot of this data. They move in anticipation to this data. Just as we saw yesterday, prior to FOMOC, we had a pretty big push upwards, like 2.5%, 3% push upwards in anticipation of 0.75. But as soon as that news came out, we crashed. So for us to see a bottom, we actually don't need inflation to crash down amazingly. We don't need interest rates to start going negative. All we need is a glimmer of a hope that we are very close to the end of this QT phase or this interest rates hike, and that will be enough for money to start flowing back in as the risk return ratio has shifted. All right, I hope that makes sense, guys. We're gonna go ahead and get into the crypto analysis now. I can talk for hours, literally talk for hours about our stuff, and I try to keep it nice and simple on this channel. Obviously, we can go into a lot more detail if we want to, but we try to make it nice and understandable. If you've got any questions, leave them down below. Let's talk about the charts. So currently, Bitcoin has crashed, obviously, a significant amount. In the last 24 hours, we saw, a pretty strong drawdown. If we go to the chart over here, from that high, about 19,890, we saw about 8% crash, guys. Pretty big, pretty big. Now, obviously, the local bottom, or the absolute bottom, according to our macro chart, is sitting at around 17,590, and we are still technically above that. So from a macro standpoint, we are still fine. And I want to really reiterate the fact that this is very strong support until it's lost. So until this level is lost, we have to assume this level is still support, and therefore we have to assume the bottom is in. Because if you watched our previous videos and we talked about the macro, and we've shown you guys a lot of indicators on the macro, and we're going to talk about a few other things today that are quite worrisome, but a lot of indicators, traditional indicators, are indicating the bottom has been in, and the bottom was actually in June, and therefore we have to rely on those indicators to a certain extent, or at least give them credibility and validate those indicators until they're proven wrong, okay? Until they're proven wrong. Now, obviously we have our downside targets. We're going to talk about those first because the market is more bearish today. Everyone wants to probably hear, where can we go down? So let's talk about that. So if we do happen to lose this level, 17,590, and I'd like to say a weekly close below that level, it is very obvious where we're going to be heading. And it's so obvious, we've talked about this, for such a long time. This is obviously our worst case scenario. If we lost that 9-year trend line, if we lost that local low, it's very obvious to where we're going to heading. And the most obvious answer is we'll be heading all the way back down between $12,000 and $13,000. This is the range of which I believe will be the next target for Bitcoin if we do lose this local low, or what you could call an absolute bottom. Now I'm going to go ahead and show you over here on our trading view just exactly what this will look like. because we posted this a long time ago, and I'm going to go ahead and show you this chart over here. And this was our structure. And we talked about this in a little bit more detail when we posted it. We talked about it a lot on YouTube. We said that this chart, this prediction will become valid if that 9-year trendline bottom has been lost. And this is where it gets a little tricky, because the 9-year trendline has been lost, correct, but the 9-year trendline bottom hasn't been lost. And our specific statement was, when a 9-year trendline bottom is lost, that is when that next leg down will occur. So a 9-year trendline bottom is still sitting right over here, $17,590. When that is lost, we do anticipate this move will continue downwards to $13,000 to $12,000 on the Bitcoin chart. Now, I don't know if I'm going to stand here and say I think it's likely. I think it's possible, but I also think that there is still a very, very good chance we do bottom out and continue upwards. There's a lot of indicators suggesting that. But at the end of the day, guys, we're just going off the data. We have no personal preference. We don't care. We sold the top. We've been trading all the way down. We don't hold. We trade the market up, down, sideways. We make money. We profit. It does not matter to me one single bit where we go. I couldn't care less. It would just be nice to know that these macro trend lines, this 4-year cycle, some indicators that are predicted, accurately, tops and bottoms for the last, 10 years are still remaining valid. But like we said, we're in a very different macro environment now. There's no doubt that we're seeing things occur this time around on the charts that have never happened. And obviously the main one that we're seeing here is the fact that we've lost that 9-year trend line. We've never seen that happen. It's never happened before. It has never ever happened before. And there's a few other ones I want to talk about, and I might actually just jump on my phone because I took a screenshot, but I can't quite remember exactly which ones I want to talk about. So let me just quickly jump on my mobile. And I wrote some notes down in here before I filmed this video. Let me just take a quick look. And I was up all night, guys, so just forgive me 1 second. Let's take a look. Here we go. Okay, so it was the RSI, and we talk a lot about the RSI. And I want to actually take up the RSI on the 2-week chart, because this is, again, something that we haven't seen happen before, which was the RSI losing a pretty significant level from memory. And this significant level was, in fact, this level here. I'm going to go ahead and draw a horizontal ray in this absolute low here. Sorry, my bad. This absolute low here, we're dropping back below it. So this is something very important, because as you can see, in every single bottom, we have dropped below it, but we've never gone back above it and then actually dropped back below it, which is pretty interesting to see. That is obviously not a good sign for Bitcoin. And obviously on the weekly chart, we have our 32.60 on the RSI, which we talked about in our previous video. I'm going to show you again over here. Every time we lose a 32.60, we see a huge rally downwards, a huge crash. We can go ahead and draw a raise in over here. 32.60 lost on the 6th or the 5th of May, okay, 2022. We saw a significant 40% crash. Not a coincidence. We lost that level again right over here, 15th of June. We saw a pretty big 20% crash. Again, we can go back in time here, guys. We lost it again, 19th of November 2018. Just on that second candle, we saw a very big 42% crash. And we can go even further back, all the way back to January 2015, even back over here, September 20, we lost it again. We saw a 24% crash. This level has predicted some of the bigger crashes on Bitcoin, not the biggest crashes, but some of the biggest crashes on Bitcoin on the weekly chart. Something to keep in mind. Obviously, we are currently actually right on top of this level. You can see where the RSI is right now. We're literally right on top. And we do need to actually close this weekly candle. It would be below this current price. And this would be the trigger. The trigger for this would be below here. If we close this weekly below this bottom, we'll be closing this RSI below the bottom. That would trigger that sell-off, that crash, all the way back down, what I believe, to $12,000 to $13,000 if that will occur. Obviously, to the upside, guys, let's talk about some more positive, uplifting, bullish stuff here. We talked a lot of the bearish stuff. That's what we think. We talked about in a few videos ago, we have less than 3 weeks to see either a new bottom, 12,000, 13,000, or breaking out of the bear market. we've got less than 3 to 4 weeks, and we showed you that video a few days ago. Less than 3 to 4 weeks, 7th of October, we believe either we create an absolute new bottom or we break this macro descending trend line, this first diagonal trend line, leading us one step forward to breaking this bear market trend. As you can see, we're still in a macro descending channel / wedge. We have 2 trend line resistances over here. We have major resistance, which sits around about this level. That first trigger, 22,684. We have many minor resistances throughout this range, around 21,600, 21,800 being another one. But clearly above this level, we have a free shot up to 28. If we're able to clear this green line here, able to clear these candles, we will shoot up to 28,000. The question is, will we be doing that or will we be going down? Only time can tell, guys. Right now, we don't know. I hope you enjoyed the video. If you've got any questions, leave them down below. Remember, like, comment, subscribe. If you want to support the channel, go ahead and sign up to Bitget, trade where I trade on Bitget, or click the link on Telegram, join our VIP, or just leave a comment and tell me what you like. With that being said, guys, I'll catch you in the next video. Cheers. Okay guys, we're going to be taking a quick look at Bitget, and now Bitget is where I personally trade. I highly recommend signing up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, can name a bunch more, KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up, well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.